All right, let's tackle a question pretty much everyone has at some point. What is the absolute best way for a total beginner to invest just 100 bucks? To get to the bottom of this, we're going to break down a really cool 4-year experiment that did exactly that.
I mean, it's the question, right? You've got a little cash saved up, maybe $100, and you know you should do something with it, make it grow. But where on earth do you even start? The options can feel totally overwhelming. So to get a real answer, not just some theory, we're looking at an experiment where someone actually did this. They took $100, split it 5 ways into totally different investments, and then just let it sit for 4 years to see which one would actually come out on top.
Okay, so here's how we're going to break this down. First, we'll look at the rules of this 4-year challenge. Then, we're going to put 5 different investments under the microscope. Individual stocks, the high-stakes picks. Then REITs for some passive property profits. We'll have a little showdown between crypto and gold, the wild card and the safe haven. And finally, the classic slow and steady index fund. Then, of course, the grand finale, the final results.
All right, Section 1, the $100 4-year challenge. Before we even look at the money, we've got to set the rules of the game. See, to judge these investments fairly, we need a clear set of criteria. It's not just about the final number, it's about the whole experience, especially for a beginner. So this is our scorecard. Think of it like an investment bake-off. We're judging each one on 5 key things. First, the learning curve. Basically, how hard is it to even get started? Then, passive income. Can it make you money while you sleep? Tax efficiency. Are there any smart ways to save on taxes? The risk level, which is a big one. How likely are you to lose your money? And of course, the bottom line, the 4-year results, the final return on that initial $100. Okay, kicking things off with contender number 1, individual stocks. This is the high-stakes world of picking individual companies. You know, what you see in the movies, trying to find the next Apple or Amazon and hoping it just explodes. And really, it's a simple concept. Buying an individual stock just means you own a tiny, tiny piece of a specific company. You're essentially placing a bet that that one business is going to do really well. But here's where it gets tricky. Look at this scorecard. On the plus side, you've got great tax efficiency and good potential for passive income through dividends. But, and this is a big but, look at the top and bottom. The learning curve is high, and the risk level is also high. To do this right, you can't just guess. You need to be reading financial reports, understanding the market. It's a classic high-risk, high-reward situation.
And wow, this result just perfectly illustrates that risk. To simulate a beginner just taking a shot in the dark, the $100 was put into a randomly picked stock, Samsung in this case. And after 4 years, that $100 was worth just 67 bucks, a 32% loss. Now think about this. If that random pick had been a different tech stock, say Nvidia, that $100 could have turned into almost 1,000. That's how wild and unpredictable picking single stocks can be. It's a total roll of the dice.
All right, let's move on to our next contender. This one is all about getting into the real estate game, but without needing, a giant pile of cash for a down payment. We're talking about a real estate investment trust, or REIT for short. Honestly, the best way to think about it is like you're crowdfunding a huge property empire. You get to own a tiny piece of shopping malls, office buildings, apartment complexes, and you get your little slice of the rent checks that come in every month. Pretty cool, right? Now, the real standout feature for REITs, you can see it right there, is that great rating for passive income. And there's a reason for that. By law, these companies have to pay out at least 90% of their taxable income to their shareholders. That makes them an absolutely fantastic engine for generating a steady stream of cash. The risk is medium because your money is spread out across a ton of different properties, not just one.
So what about the results? Well, it was a modest but positive return. The investment itself actually lost a tiny bit of value, which makes sense given what the pandemic did to commercial real estate. But here's the magic part. Those dividends, that passive income we just talked about, were enough to push the whole thing into the green for a total gain of just over 10%.
Okay, time for a really interesting matchup. It's the new kid on the block versus the oldest player in the game. We're pitting the wild world of cryptocurrency against the ancient safe haven of gold. So first up, the wild card, crypto. And we're talking specifically about Bitcoin here. At its core, it's a form of digital money that's not controlled by any government or bank. And because there's a limited supply of it, only so many will ever exist, a lot of people have started calling it digital gold. And just take a look at that risk level. Very high. That is not an exaggeration. The price of crypto can go to the moon, but it can also fall off a cliff in a matter of hours. It's incredibly volatile. It's also worth pointing out the poor tax efficiency. With stocks or REITs, you have more options to protect your gains from taxes, but with crypto, not so much.
But with that very high risk can come some absolutely mind-blowing reward. After 4 years, that initial $100 investment in Bitcoin exploded to over $650. That's a return of 552%. Now, it is so important to say this. That kind of jump is not normal. It was a truly historic run for Bitcoin.
And this slide really cuts to the core of why these two assets are so different. Crypto, like we just saw, is a high-risk, speculative gamble on future growth. Gold, its opponent in this challenge, is the polar opposite. For thousands of years, it's been seen as a safe haven, a way to protect your wealth when things get chaotic. They serve two completely different purposes in an investment portfolio.
And that brings us to our final contender. This is the strategy that legendary investors, I'm talking Warren Buffett himself, recommend for almost everybody. The beauty of an index fund is its simplicity. Instead of trying to find that one winning needle in a haystack, you just buy the whole haystack. It's like a basket of stocks that holds tiny pieces of hundreds or even thousands of the biggest companies out there. So, an S&P 500 index fund means you instantly own a small slice of the 500 largest companies in the US, all at once. I mean, just look at the scorecard. Low learning curve, great tax efficiency, and the big one, low risk. Why? Because you're instantly diversified. Your money is spread so thin across so many successful companies that if one of them has a bad year, it barely even makes a dent in your overall investment. This is the definition of not putting all your eggs in one basket. And the result speaks for itself. A fantastic, steady, no-drama return. The $100 grew to almost $180. That's a gain of nearly 80%. It just goes to show the power of betting on the overall market to do its thing and grow over time. No stress, no picking stocks, just solid, consistent performance. Okay, the moment of truth has arrived. We've broken down all 5 contenders. Now let's line them all up side by side and declare a winner. And here we have it, the whole story in one table. You can't miss the insane performance of Bitcoin, but you also can't miss its very high risk rating. You see the painful loss from the single stock pick, proving its own high risk. And then you see the index fund, low risk, low effort, and a truly impressive, almost 80% return. For a beginner who wants the best all-around option, an index fund is the hands-down winner. This chart really drives the point home, showing the top 3 performers. Yeah, Bitcoin's bar is way up there. It's astronomical. But look at the index fund. It delivered a powerful, steady return that was more than double what gold, the traditional safe choice, brought in. It's a really compelling visual for why slow and steady often wins the race, especially when you factor in the risk. So, after all that, what are the big lessons from this 4-year journey? Well, number 1, start early. Seriously, time is your superpower in investing. It lets the magic of compounding do its work. Second, diversify. That 32% loss on the single stock is the perfect, painful example of why you don't put all your eggs in one basket. And finally, you've got to know yourself. The best investment for you is the one that fits your own goals and how much risk you're actually comfortable with. You know, what this whole experiment proves is that even a small amount, just $100, can turn into something meaningful. The most important factor isn't how much money you have to start, it's when you start. So the real question this leaves us with is, what are you waiting for?